Hello everyone and welcome to your Glassnode video report for week 50 2022. Now this will be the last report that we have for this year, taking off the back end of the year. So thank you. Just before we get started, thank you so much for everyone who tunes in week after week. It's such a pleasure to actually make these videos for you, and I read all the comments, and I know that you guys are having you're getting a lot out of these things and learning a little bit more each time, and that's really what these videos is all about. It's teaching you how to use these tools just one snippet at a time. So what we're going to do this week is a bit of a year in review, look at the year that was in 2022, and really some of the data and telling us where does it leave us for the setup for 2023. Now, as anyone who hasn't been living under a rock knows, it's been a pretty volatile and chaotic year. And we've seen some pretty nasty price action. We've seen both BTC and ETH fall more than 75% from their all-time highs. We've seen massive amounts of realized losses. We've seen capitulations across the board, stress in the mining industry. We saw the Ethereum merge. And we've seen some very significant shifting trends in the stablecoin market. So we're going to explore this from a whole different set of angles. It's going to be a bit of a snapshot. I'm not going to focus too much on the recent events of FTX. I feel like we've essentially done that to death. What I want to do is a bit more of a bit of a look forward. What has happened over the course of this year, and how does it set up the market for the future to come? So as always, please do give us a rate, a share, and a subscribe. It really does help this channel. And as I said at the beginning, it is such a pleasure to make these videos for you all. I do hope that you're enjoying them. And for those who come back week after week, thank you very much for your support. And I certainly look forward to seeing you in the new year. Let's get started. Okay, so starting with our price action, and this is the year-to-date price chart. If you can believe it, we were up here above $47,000 at the start of the year. And as you can see, it's been quite the ride. Now, you can also see that the legs down have been starting to get smaller and smaller in scale, and we are spending much longer in consolidation. Up here, before we had the collapse for Luna, this was about 2.5 months about 4 months from January through to April. We then had over 6 months down here after the June sell-off, through to October, and then into our current pricing range. So we've essentially spent the last half of this year within this 24,000 down to 15,000. This has kind of been our trading range. You can see that these consolidation ranges are starting to get a little bit of length to them, and volatility is really coming out of the market. You can see a lot more intraday volatility going on in these previous consolidations. Here, we're essentially walking sideways, quite impressively so. And to really bring this home, you can see here our annualized realized volatility. Now, each of these curves is a different time frame. So what is the volatility over in the red curves, 1 week and 2 week? And then in the blue and green curves, we're looking at multi-year. Now, what I really just want to focus in on is the tips down here of these red curves. And they are essentially back down towards really July 2020 levels. So we haven't seen the market have this low in terms of volatility really since before the bull market actually started. So it really does go to show that what we're seeing here on this chart, where we actually do have very, very sideways and flat price, is actually being reflected in the realized volatility. It's a very, very low volatility, at least on a relative basis, environment for Bitcoin. Now, what we can also see here is Bitcoin and Ethereum in orange and blue respectively, looking at their futures trading volumes. And as you can see, this is the bull market, where we've got a lot of volatility, a lot of trading activity. We are back down to multi-year lows. January 2021 is really the last time that we saw trading volumes, and both BTC and ETH are trading somewhere around $9 to $10 billion a day. So this is historically low. Now, granted, with our futures volumes, we're only looking at a couple of years worth of data, but essentially of those couple of years, this is about the lowest that it's been in a very, very long time. So we are seeing that squeeze of liquidity. There's been failures of many market makers and those who had leverage and loans. So there just is liquidity leaving the system. This is just part of the system we are currently in. Now, sticking with the whole concept of leverage and futures markets, we've got two charts here. This one is the annualized perpetual funding rates versus 3-month rolling basis. That's a bit of a mouthful. What we're looking at here is how much is the interest rate or the premium that traders are locking in with futures markets. Positive values means that if for perpetual swaps at least, if you are long, then you have to pay an interest rate to those who are short. And we typically see this in bull markets. In the reverse, so when the orange goes into the negative territory, that's basically saying that you have to pay to be short. It's called backwardation. Whereas in the bull market case where futures trade above spot, that is called contango. Now, what you can see is that same concept where volatility has squeezed all the way out of this. Anybody who is running a cash and carry strategy, buying spot, selling futures, we have essentially squeezed the premium down to those basically nothing, especially relative to treasury yields and the like. And if we zoom in over the last really 12 months, what we can see is that we're actually in backwardation. So this means that on perpetual swap markets, traders are paying an interest rate to be short and hedged. We're also seeing that pretty much all of the long speculative capital has been squeezed out. And on our perpetual swaps, it actually went down to negative 2.4% during the FTX chaos. So generally speaking, we don't actually see this happen very often. The last time was back here in June, July 2021. So generally speaking, Bitcoin doesn't stay in a backwardation state for very long. And we're starting to see both of these normalizing back up to pretty much a zero interest rate across the board. Now, these curves are showing for Ethereum and Bitcoin again in blue and orange, what we're calling the open interest leverage ratio. The way to think about this, we've got open interest, or that's the disturbing force in the numerator of that ratio. And in the denominator is the market cap. So how much relative to the size of the market cap is held in futures leverage. Higher values means there's a lot more leverage, lower values, less. Now, you can see these charts. There's a few things to observe. The first one is particularly for Ethereum, but also Bitcoin, the massive drop-off that we had in leverage following the FTX implosion. Now, this is obviously because FTX's books got closed out. There was also a lot of traders who would have got squeezed to the downside. There's also people that just need to close their positions and end out the year. So you can actually see that Ethereum had much more leverage relative to its market cap baked in. Over 4.69% of its market cap was held in futures open interest. A lot of this was probably residual following the merge trade as well. So a lot of this got squeezed out and they're starting to collapse back down towards that 2.5–3%. Where they've been for most of this year at least, but still elevated relative to previously in the cycle. And what this all tends to suggest is there is still a reasonable amount of leverage in the system. It is continuing to unwind. However, it appears to be a lot of it is actually short interest, and that's highly likely to be people who are hedging and actually hedging risk using futures. There will also be some speculative capital in there to the downside, but that is really what it looks like is going on overall. Now, we're going to move into the on-chain space now, and what we're looking at here, now that we're getting towards the back end of the year, we're looking at the 365-day sum of realized profit and losses. Now, the way to think about this is what we're looking at is how much did the market, when we look at all the coins that were spent and moved, those that were accumulated at 5,000, 10,000, 6,000, and then spent on our bull market rally up here at higher prices, that's going to realize a profit. Now up here, we realized about $455 billion. That's the total gain made by the Bitcoin market based on looking at coin spending behavior. Now, the market gave back about 47% of that, 213 billion or thereabouts, over the course of the last year. And you can see how the profits roll into the losses. Now, this is actually a very similar pattern to our 2018 market. We had profits and then we rolled into the losses, and the peak losses occurred somewhere down near the bottom. Now, the other thing to note about this particular chart is what we're looking at is about 47% of the profits gained in the bull have been washed out of the system. We actually looked at this last week on the realized cap. If you were to sum these two together, you would actually get the realized cap, right? Not with a yearly sum, but if you actually combine your realized profits and losses, that's essentially what the realized cap represents. So we've given back 47% or thereabouts of the profits that were taken in the bull. And this is pretty much the exact same amount that we had in the 2018 run. It was about 48% of all the profits on the way up were given back on the way down. But what that does mean is that the realized cap, the amount of value that's been invested into BTC, is slightly more than 50% higher than where it was at the start of the bull, which is very typical. It's what we generally see during these market cycles. So you can kind of see that you give some and then you lose some. This is the way that these market cycles tend to go. And we've essentially seen this for each previous market cycle as well. Now, this metric is looking at the profit and loss return bands, but explicitly for long-term holders. Now, the reason I want to look at this is you can see the amount of losses being realized by these long-term holders is about 0.1% of the market cap per day at the peak. And you can see that this really compares only to the 2018 and the 2015 lows. We're basically seeing that the amount of capital flushed out by long-term holders, note the dark red too. These are people who locked in 50% to 80% losses. So long-term holders took two massive hits. The first one here in June when we had that first sell-off below 20K, and then FTX was actually even more extreme. And a huge reason for this is that we spent a lot of time up here in this above $30,000 range. Lots of long-term holders got locked in up at these higher prices, and they have been capitulating the whole way down. Now, I'm actually going to jump down to this metric first, and we'll climb back up to that long-term holder supply because it really flows on quite nicely from that previous chart. This is, I think, well, this is my favorite metric of this particular newsletter, but what we're looking at here is the concentration of coin supply clustered by age band over time. So it's a bit of a thing to get your head around, but what we're looking at is where were the coins accumulated, spent, and moved around. Now, when you see these red colors, you can see that they're typically through the bull market in 2017. And as we broke the all-time high in 2020, we started to get that spending behavior. Now, these red zones are old coins being spent. So this is long-term holders taking profits. And you can see this, let's actually zoom out on a very similar time frame, 5 years. This spending behavior here is all these long-term holders, the long-term holders supply declining because they're spending and selling to new buyers. So there's a transfer of wealth from old to young. Now, what you can also see is that through the 2017 bear, note that we form these large zones where you get this kind of highly dense. The darker the colors are, the higher the coin density. And you can see it's a little bit lighter up here, but it starts to darken the further down you go. And you can see very, very dark patches down here in the 2018 bottom. Now, you can see a very similar thing. Note how it's quite light in the top. It's quite light up here in the top. And as we get further down, you're seeing more and more and more of this overall supply getting denser. This is a combination of two things. You can see these hot zones. These are people who are spending and capitulating out. But that also means, because even up the top, for every seller, there's a buyer. So what we're seeing is that we're getting increasing amounts of accumulation and supply density. There's more people stepping in and saying, this is a value zone, but simultaneously someone else is saying, get me the hell out of here, all within this zone. And the further down we go, the more this behavior is taking place. Capitulation and accumulation occurring at the same time. Depends what side people are on. Now, that's why I want to bring back up to the long-term holder supply. In fact, I'm going to go in on a year-to-date basis. This is actually a really interesting dynamic. Now, for those of you who've heard me talk about long-term holder supply in the past, recall that this particular metric takes 5 months. The reason we use this is after 5 months or 155 days, the probability that a coin gets spent is massively diminished. So statistically speaking, we see much less spending over 5 months than we do under 5 months. Most of the daily activity are 5-month-old coins. So that's why we choose 5 months as the long-term holder cutoff. Now, for this metric to go up, you need coins crossing that 5-month boundary, which means they were purchased 5 months ago. So in many ways, when this metric is pushing higher, it means that something happened 5 months ago and those hodlers did not spend from then on. Now, spending, on the other hand, is immediate. So you can see here the FTX sell-off, we resulted in a fairly substantial, it's about a 1.2 or 1.5%, if I remember correctly, drawdown in long-term holder supply. People capitulated out, and this is what we're seeing here. Long-term holders took in massive losses, their supply declined, but 5 months ago, where were we? We were up in this zone. Note how there's lots and lots of coins that were capitulated and thus bought by somebody else down in this zone. So what we're seeing, there's a natural gravity that wants to push this model higher. If this had continued to trend lower, that would be a bad sign because it's showing that FTX has blown up and long-term holders have lost confidence. They want to just get out of this thing. Bitcoin's over, it's dead, it's finished. That initial spending has essentially stopped on November 18th, and we are now back to the natural gravity. Note that the gradient here is the same as the gradient here. We are seeing that all of those coins that were accumulated in this previous pricing range, well, not all of them, but a good chunk of them, have not moved since. So there's a natural push. This thing is now at all-time high, 13.9 million BTC. So you can see how all of these models are telling us a consistent story that there's been a stack of capitulation and accumulation in our previous consolidation range, and we're actually seeing a second phase of it down here as well. So again, that doesn't necessarily tell us that the market's at the bottom or that we don't have some kind of pain left to go. The market's in a very tricky position, particularly with macro all around it. But what we are at the very least looking at is where is the Bitcoin supply? What is the investor behavior? And what we are seeing is that lots of coins have changed hands, but have not changed hands again in this particular price range. That's the ticket to take away. They have changed hands to a lower cost basis, and they haven't changed yet again. If we get price lower, maybe that's a motivator. If we get price higher, maybe that's a motivator, but we'll have to wait and see. So to close out on the Bitcoin section, we're going to look at the mining industry. This is a bit of a snapshot of what's going on. So what we did have is the largest downwards difficulty adjustment, 7.3%, that we've seen in some time. I think it's the largest that we've seen since the Great Migration back here in June, July 2021. So we have seen a fairly substantial pullback in difficulty, which is going to mean that there's a lot of ASIC rigs that have been switched off. Now, what this has resulted in is the hash ribbons have now inverted yet again. So what we have to wait and see is this just a temporary event? Sometimes if a large miner has to switch off for whatever reason, sometimes they do grid balancing or various other things, or they're just moving their rigs because they just sit in semi-trailers and they can shuffle them around. So maybe this is a temporary factor, but we may also be seeing that these mining rigs are just not profitable to operate and they need to be switched off for profitability reasons. And that latter conclusion should not surprise us. Here is the hash price, which is the average revenue per exahash applied to the network. And as you can see in both USD in blue and BTC terms in orange, this chart basically goes down only. So we are only just hovering above all-time lows. What this means is that miners per hash applied to the network, even though price is at 17.5K, we are currently below the hash price that we were back here in September, October 2020, when price was 10K. So even though that the actual price is 70% higher than it was back here in October 2020, there is 70% more hash power fighting over that same block reward. So there's more people fighting over the same BTC denominated reward. So even though price is higher, it's harder to come by, and thus the hash price keeps going lower. It's a really brutal industry. Mining is tough business. So given that, it does not surprise me that we're seeing some of those miners having to be switched off and some hard decisions having to be made. Mining industry remains a bit of a stress point. Now, on the Ethereum side of the equation, what really the big news for this year was the merge. That was kind of one of these massive engineering achievements. It's been built in the works for many, many years. This chart on the top left here, I think, really shows that change point between proof of work, the natural variability, and the probability of finding a proof of work block. This is the mean and median block interval. So how quickly, or what's the time between blocks? And you can see the merge clear as day here on the 15th of September when it moves towards the predetermined. So whereas proof of work is basically an indeterminate puzzle, there's a probability associated. It's on average 13-second blocks. Once you move to proof of stake, they're essentially, the slots are predetermined to be 12 seconds apart. So you can see that the mean collapses to 12 seconds, and there is really very little variability from that point on. Validators continue to rise. So we've seen about 56,000 validators come online, about a 13% bump since the merge. So we are still seeing deposits coming in. In terms of the overall net inflation rate, what we're looking at here in the blue, prior to the merge taking place, the amount of issuance going on was about 4.5%. That was the issuance rate prior. After the merge, it hovers somewhere around plus or minus 0.1%. That's what the purple curve is showing. Now, once we factor in the burn, we're actually seeing it go deflationary at certain points of time. So even though the actual nominal inflation rate to validate is about 0.55%, we are seeing that the burn is pretty much consuming most of that. So this chart here is looking at the total net ETH issued since the merge. So here's the merge here on the 15th of September. We saw a peak issuance of about 14,700 ETH. We saw peak deflation about 2,400 ETH, and we have, as of yesterday, crossed over into minus 1,800 ETH. So it has been deflationary net since the merge went live, and it kind of shows you just how. By the way, if we had continued with the previous issuance schedule, there was about 1.04 million ETH. So a very, very significant change based on the actual monetary policy decision that was changed for the Ethereum network. So since the merge has gone live, it has been net deflationary by about 1,800 ETH. Now, the last thing I want to touch on is the stablecoin market. So stablecoins have become a centerpiece of this industry. They are the base trading pair for most assets, both on DEXs, but also on centralized exchanges. And what we have seen is that since March, right before Luna started to collapse, kind of at the peak of the buying, actually, by the Luna Foundation Guard, that was really when the stablecoin supply peaked about $160 billion. And since then, we have seen outflows between 8 billion and 4.5 billion per month in stablecoin outflows. So overall, stablecoin supplies have been on the decline. You can see Tether dominance. This is looking at the dominance of the top four. From about 85, 86%, Tether has been in slow decline. But since that point, since around July, Tether's actually stabilized between about 45 to 50% dominance. Interestingly, USDC came up and peaked at 38%, but has since declined closer to around, 31%. So USDC is actually losing market share. And BUSD, particularly since Binance introduced both feeless trading for Bitcoin, but also consolidated their stablecoin order books, Binance USD has increased quite significantly from about 10% of the start of the year to over 16% at the moment. So we're seeing that Tether is holding its dominance, BUSD is on the ascent, and USDC is actually on the decline in terms of overall supply dominance. And despite all of the chaos and what's been going on, there is no question that stablecoins have a product market fit. What we're looking for here is the transfer volume. Now, stablecoins, this red curve here is the total transfer volume on Ethereum for those top four stablecoins. DAI is in purple, by the way. And really, for most of 2021, we saw about $16 billion a day in transfer volume. That has actually upticked as price has fallen, particularly since around May 2022. Price has fallen from 40,000 down to, well, below 20,000, but stablecoin volumes have actually increased to between 20 and $30 billion per day. So we're actually seeing a huge amount of stablecoin transfer volume on the Ethereum network. They continue to grow in dominance in terms of how much value is flowing through in stablecoins. So stablecoins have become a cornerstone of the industry, and it is likely that that trend will continue as we move into the different years. And we will watch and see how this dominance plays out, because each of these stablecoins has a unique set of risks, and the market will change their preferences over time depending on how those risks play out. So thank you everyone for tuning in. Hopefully you enjoyed this season. This is the really the 50th episode we've done this year, one per week. We are looking forward to doing this again in 2023. So please, as always, let me know if you have any queries or comments, and I want to wish you all the very best for the holiday season. Take a break. Generally speaking, Decembers tend to be quiet in this industry and actually across all markets. So do take that time to rest and recover. Because this industry and this market can be pretty taxing. It doesn't sleep, and that can be quite challenging. So make sure you get some rest, and I do look forward to seeing you in the new year. Until then, see you then. Cheers.